Hello and welcome to WealthWise. My name is Jeff Hirsch, and I like to say that those who understand market history are bound to profit from it. We are live on YouTube and X. It's being restreamed, and here's what's on my radar. So number one, I expect a monster Q4 rally and S&P 7100 by year end. You know, gains beget gains, and when bearish seasonality does not transpire, it is a bullish indication that more powerful forces are at play. New all-time highs in September and October have historically been bullish. I expect the bull to run through Q4, S&P 7100, and then get toppy when the calendar turns to 26, where a midterm bear lurks. October, the famed month, is really a bear killer. It's the bargain month. It's the best time to buy stocks, especially small caps and tech stocks. Our best 6 months and best 8-month switching strategies are setting up well for their MACD seasonal buy signal. The term Octoberphobia, coined by my father, Yale Hirsch, founder of the Stock Traders Almanac, has been used to describe the phenomenon of major market drops occurring during the month of October. It appears that the market is about to overcome its usual Octoberphobia this year. So we're tracking the most bullish post-election year patterns. My 2025 best case scenario forecast, which I put out last December, for a 12 to 20% gain for the year, are now in play. Actually, pretty much 20%. That's where the 7100 comes from. We had the best worst 6 months. That's the sell and May period from May to October. Yes, there's still some time left, but it's the best on record so far. It looks like we're going to get some more. That means no losses in Q4, about 5-6% average gains, 20+% gains for the year. Post-election years are the best year of the 4-year cycle since '85, and I've got a couple of ground floor stocks, new stocks to share with you. StoneX, SNEX, and Commvault, CVLT. I own both of them, and I recommended them to my newsletter subscribers a few weeks ago. You can go to Stock Traders Almanac for more on those two and my other latest picks and market analysis, again, at stocktradersalmanac.com. And you can get a free copy of the Stock Traders Almanac with a subscription. Check my Almanac Trader feed for more, LinkedIn as well. And without further ado, let's bring my old friend Les Masonson in. How are you, Les?
Good afternoon, Jeff. Doing great here in Florida. Thank you.
Excellent. So Les has a brand new book out. It's the QQQ and TQQQ ETF Profit Machine. It's ranked up in the top books on Amazon for investment analysis and strategy. I think it's a game changer for ETF traders. It's clear, insightful, a practical guide for investors seeking to navigate and capitalize on the opportunities in the Qs and the TQs. I've known Les for many years. His work's impeccable. His market trading and finance experience and knowledge are vast. It's an honor that he values our seasonal work so much that he's put it in a chapter 5 in his book, using our best 6 months MACD signals that I just mentioned. He is the founder and president of Cash Management Resources, where the main focus for the past couple of decades has been on ETF trading strategies. Before that, he was an advisor at several firms, JP Morgan Chase among them. Then before that, major banks and money centers, Citibank, Bank of America, Irving Trust Company, and he's also been independently providing treasury management consulting to corporations. So once again, thanks, Les. Love the new book, killing it on Amazon. You got a copy you can hold up. Oh, I see it behind you over your shoulder. Very nice.
I could just make it easily. People could just see the book here.
I like the cover. It's all about money. Good job. It looks nice.
My pleasure, Jeff.
So how did you first get into the stock market? I mean, you clearly been around for quite a while. What was I was with my dad. I mean, I was looking at charts in my pajamas. What was the thing that got you into it?
I was in my shorts and T-shirt in 1957 when my grandmother gave me 1 share of Pan American Airways stock. 1 share? 1 share out of the blue. I wasn't aware of the markets or anything at that particular time. So I knew she was involved because she had a broker down in Wall Street. And believe it or not, he was buying her IPOs.
Wow.
70-year-old grandmother buying IPOs. And what was strange about the market in those days, the commissions were huge.
Yeah.
So the brokers did have the yachts.
The spreads were huge between the eighths and teenies.
Well, even that, a $10,000 transaction, they charged $200 commission.
So with your financial advisor fiduciary experience, would you recommend IPOs to a 70-year-old grandma?
Every day of the week. And then I'd be in prison the next day.
That's right.
In any event, so that started me. So I went to the library, local library. I started reading about the markets. I started reading books on technical analysis. So I became self-learned. And over the years, I've built a personal library of over 500 books.
All right, I got to ask.
I just love reading about the market, technical analysis, psychology, trending markets.
What are some of the your top classic technical analysis books?
Well, of course, let's see. I have Greg, the Investing with the Trend. Greg Morris has books. Bill O'Neill, Reminiscences of a Stock Operator. Books by John Murphy. And I have hundreds of books here. Probably 20 of them are the tops in the field. And I really enjoyed reading them very much. And How to Make $2 Million in the Stock Market by Nicholas Darvis. And I'm sure you've read them all too, Jeff, over the years.
Some of the authors I know. There's a few other things. I mean, what are some of the technical indicators that you rely on? I mean, moving averages, pivot points, VWAP. What are you into these days?
Well, what I'm into for my day trading is what I do. I'm currently trading in the NASDAQ futures. Previously, I traded the TQQQ. And what I use there is the RSI indicator, relative strength index, but I set the default. Instead of using 14, I use 7. I use the MACD, but I use 6, 13, and 5. I cut that in half.
I call it MACD.
Yeah, MACD.
And we use the 817.9 on the buy side for our best months.
Right.
And then the old 1226.9 because bottoms are more of a process. I know Marvin Appel used, I think it was the 619.9 for a while. They were playing with some other things, but what's the short-term MACD you use?
Well, I use 6, 13, and 5 because I worked with a few of them, and I found that the standard one's a little too late.
Is that on the daily closes, or is that on a different tick for the day trading?
I'm using a 1-minute chart, Jeff.
So that's 8, 13, 5, 1 minute.
6, 13, 5 for the MACD.
Now, for the people who don't know, MACD stands for Moving Average Convergence Divergence, and it's a combination. It was invented by Jerry Appel, Marvin's dad, the late great, who I knew as a kid. It's a combination of several different exponential moving averages, and simply an exponential moving average is a moving average that puts more weight on the most recent data point. So you take the first two numbers, you take the difference between those two exponential moving averages, and then you plot an exponential moving average of the difference to get the crossover or the histogram that you see. So just what I give a little.
That's the second one, and then on the chart itself, I use an 8 exponential moving average. I use a 20 simple, a 50 simple, and then I use the Keltner bands.
Okay.
They're called Keltner Channels.
Right.
But I use the 2 and the 3 standard deviation channel together.
And this is just trading the NASDAQ E-minis?
Yes. And then I use, of course, volume weighted average price.
So the VWAP.
The VWAP. So what I wait.
VWAP or a regular VWAP?
The regular VWAP. So then I wait for an extreme condition, either on the low side or the high side. And then I go in and make my buy. And when it gets to an extreme point on the upside, I sell it. But I also want to mention, I use Heikin-Ashi candles, not the regular candles.
What's the
difference? It's a smoother ride for me.
What's the difference in the Heikin-Ashi candle and a regular candle?
Well, it's a much smoother looking candle. You don't see the breaks in between the the candles each minute.
Oh, I guess it's better for the day trading.
Yeah, it gives you more of a trend following scenario. It's not as jumpy or as, up and down as a regular candlestick.
And you're not staying in overnight. This is all, you're in and out during the day.
Absolutely. I don't want any overnight risk.
Yeah, who knows? Who knows if you're going to make it the next morning? I mean,
well, imagine October 18th, 1987. You went to sleep and said, "I hope tomorrow's good," and then it was down 22.7%.
Or the flash crash in 2010, or the Christmas crumble in 2018. Any of those one day things for sure.
So go ahead, Jeff.
That's pretty cool. When did you get started trading? How did you get started?
Probably in 1987. I was at my desk during the day of the crash, and the whole screen was red.
What desk was that? Were you at one of the banks?
No, I was working. I was trading for myself at that point.
Oh, just at your own desk trading.
Yeah, I left the banks in I think early '87, and then I set up myself. And actually, I had to buy a satellite dish to put on my back deck so that I could get the trades coming in.
Okay, so now what software are you using now? What programs are you trading through?
My broker is Interactive Brokers, and I use their software and I use their charts. But I use when I do some work in the evening, I go to stockcharts.com. I have etfaction.com, etfreplay.com, TradingView, and High Growth Stock Investor. So I have a lot of software. A lot of it is very high quality. And we are very lucky to be living while we are these days compared to 20, 30 years ago, where you can press a button and have the whole market be evaluated for you in 2 seconds.
I remember we used to have to call our broker to make trades. You couldn't just, it was crazy. And you had to, have somebody you trusted that could split the market makers instead of you being able to do it. I use Interactive and stock charts and some other things too. So I get it. So just to divert for a second, I'm curious, you've been around a long time. You were clearly there when the 87 crash happened. What's your take on this market right now?
The market is just way beyond where I thought it would be.
So,
in other words, I thought after the market came back in April and reached the top of where it was prior in the year, it would just hit the top and then collapse, during May through October, following the pattern that you're very familiar with. Unfortunately, the strength is there, and we are at all-time highs, as well as in gold and silver.
Mm-hmm.
Most people are not aware of the fact that over the past 4 years, gold has outdone the S&P.
For the last 4 years?
Correct, if you measure 4 years back.
Like GLD versus SPY?
That's correct.
Okay.
And also over the past, I would say, 10 years or so, Berkshire Hathaway has not done as well as the S&P or the QQQ. Although when it started back in '64 to the current time, it's up, Berkshire Hathaway is up 5.5 million%.
A big number.
5.5 million% since it started, but the last 10 or 15 years, it's not been as good as the general average. But what I also think is the issue, the Mag 7 stocks have done tremendous in 2024, 2023, and they're still going strong. The point being now that only 4 of the 7 are very strong. 3 of them are a little weaker than they were last year. But I think they're going to be around for a very long time. They're very large companies. They're a third of the market cap of the S&P. And whether or not they have good earnings or not will impact how the S&P moves up and down. I also expect a number of other companies in the NASDAQ 100 to move up and maybe take some of the Mag 7 positions as far as their growth in earnings. For
Right.
example,
Yeah.
Palantir and Broadcom. So those are doing terrific. I also want to mention the fact that a lot of people may not be aware of this, that the QQQ has 100 stocks in it, and those are a subset of the NASDAQ composite. And they are the largest market cap stocks in the NASDAQ composite, excluding financials. Okay, but they do have one extra ticker in there, and that is the fact that Google has two ticker symbols
Right.
in there. So that's 101 stocks. And what's interesting about the QQQ is that each year in December, the index is reconstituted. So they bring in about 3 to 5 different stocks, and they eliminate about the same amount. So you're always getting fresh, high quality, dynamic, tech oriented type companies. And it's interesting that in December, they added Palantir. Talk about good timing.
It's a great timing.
Yes, that's what I mean.
They
So
probably read an early copy of your book.
well, yeah, it was pretty good. And I think we're in for a long, big bull market. We will have bear markets along the way. I follow cycles from the Foundation from the Study of Cycles and other places, and they're expecting a big bear market in the next year and a half or so.
I mean, did you hear my opening remarks about the midterm bear?
Yeah, I did, certainly.
So
Yeah.
that's kind of lines up. I'm sure they're looking at some other cycles, but some
Yeah,
different.
but a lot of the cycles are peaked in August that they follow. So it's the market is actually going beyond the norm in the cycle work that they do. So
The
things
4-year cycles peaks towards the end of this year.
well, it depends on what you're looking at. Even gold and precious metal cycles are at their peak right now, according to the work that they do. Doesn't mean that's not going to go any further. They're both very strong.
I'm referring specifically to the 4-year presidential election cycle.
What's your question?
I said I'm referring specifically to the 4-year presidential election cycle.
Right.
Right.
Yeah.
So you think a little bear market likely in the next year or so?
Absolutely, it is. But the point is, you don't have to guess. So you look at your charts and you see whether or not the index or the stock you're working with is above the 20 simple moving average. Okay, just look at it. If it's
that's your line in the sand, the 20 simple.
Yeah, that's the for anybody, especially in a bull market. And once it craters below the 20, you want to take some money off the table, certainly. And if it craters below the 50 moving average, 50 day, you want to be out of there, especially in retirement accounts.
And then when you get the death cross, when the 50 crosses the 200, that's when you buy again, right?
No, you have to see. I would say you want to buy again when you come above the 20.
The research I've done shows that this death cross that everyone talks about usually coincides with the bottom, as it did in April.
Not the work that I've seen.
Well, recently, the last few decades.
Okay, well, that's a little slow, that indicator.
It is, but the death cross is not an indication to sell by any stretch of the imagination.
Well, I don't use that as a sell signal.
No, yeah. It's more of a buy. So let's talk about the book. Appreciate your insights on the market and technicals. What's the crux of the book strategy? What should readers expect to come away with?
They should come away with the fact that they should have a certain percentage of their portfolio in tech stocks. Okay, they have to decide what percentage is reasonable. If you have an S&P index, you have a third of that in tech. If you have other mutual funds or ETFs, you may have a little higher. But each investor and trader should determine how much they have in tech and whether they think it's enough. After determining that, they can then decide whether they want to add some QQQ to their portfolio to make sure they get up to the percentage they want, or perhaps some TQQQ. But TQQQ is a triple leveraged ETF, so that's much safer for experienced traders to play the market in, because it's a very volatile instrument. So the average investor should stay away from that. However, interestingly enough, the last chapter in my book, I mentioned that people should consider using TQQQ as a buy and hold strategy. And I thought I'd never say that because I'm a big believer in market timing. So what I'm recommending, let me
What
finish.
about all the? Yeah,
Let me
go ahead.
finish, Jeff.
Yeah, go ahead.
There's a reason and what I'm going to say. So the reason I'm saying that is if you have a portfolio of whatever it is, and you want to take a gamble on what the next 10, 20, 30 years will be, take 1% to 5% of your portfolio, wait for a 25% correction in TQQQ, and put 1 to 5% of your money in there and let it run. However, you should hold it for at least 10 years and hopefully 10, 20, or 30 years, and then let it ride. Because since TQQ has come into existence on February 10th, 2010, until yesterday, it's up 24,000%, even with 2 or 3 50% corrections and the 80% correction in 2022. So it's a long-term hold for a small percentage of your money. If you want to do it, put it away for your child or your grandchild. And just something I thought I would mention it can really impact your portfolio tremendously at the other end. And if you lose your money, you're not losing too much.
That's good advice. I mean, waiting till it goes down 25%, I think, is
at least. In other words, the next bear market. Wait for the next bear market to turn, and then put your money to work.
Otherwise, you get chewed up because it tracks the daily.
Yeah, otherwise, if you're not trading it, you're going to get killed
because of the tracking the daily move.
Right.
And
so,
not getting
and they have an ETF that's the opposite of that. It's called the SQQQ. It's triple leverage negative.
And you don't like that one?
Yeah, it's good to use about 2 weeks a year if the market's falling, like in this past April. But who knows at that time frame is going to kick in. The problem is that stock is the SQQQ has had 5 inverse stock splits already, because the price has gotten so low. The people at ProShares have to raise the price up, so they have 1 for 10 stock splits. The chart of SQQQ is going south forever.
So explain a little bit. Take a little bit of time to explain the dangers of these triple leveraged, ETFs, these derivatives. What's the concern for traders there?
The concern is that they were set up to be 3 times the QQQ performance over the course of 1 day. Okay, at night the ETF gets not reconstituted, but it gets reset. So if you're over a period of, say, a couple of days and it's going up, you're doing fine. But if the price is down or flat, the ETF starts to decay very heavily, very quickly. So you should not expect it to be 3 times the QQQ every single day you're watching it, because it depends on the market situation. If you're in a bull market run, it's going to be more than 3x. If you're going to be in a flat or down market, it's going to be certainly losing money. So the key there is to be very careful. You want to have a trading strategy. You want to use technical indicators. You want to cut your losses when you have them, and you want to be extremely careful.
How short do you cut your losses?
Everyone has their own limit. You can some have 5%, some have 10%, some have 20. Because with this ETF, it can go down 5% in 1 day in a bad day in the market. So you have to decide for yourself based on your personal composition.
Can you tell us what your level is?
My level is about 5%.
For the TQQ?
Right.
Thank you.
At most. Sometimes I'm out even much tighter to that because I'm using 1-minute charts.
Right.
It doesn't even get to 5% sometimes because I'm out way before then.
But you're actually trading the E-minis right now, mostly anyway, right?
Yes, the E-minis. But
and what's the difference in the movement between the E-minis and the TQQ? They track about the same?
if you look at a chart of the QQQ, TQQQ, and the E-mini, it's the exact same chart. Exact same chart with the same.
So
if you put any indicators on there, you'll have the same readings. The only difference is the value of each. In other words, the QQQ moves every, a couple of dollars at a time. The QQQ moves more than that. But the E-mini, each point of the E-mini NASDAQ is $20. And years ago, when the E-mini was like 10,000, now it's about 24,000. $20 was a good number back then, but now a 1 minute bar on the chart could be 10 or 20 points.
So
1 minute bar is 10 or 20 points.
So what's in it for you? Why do you trade the E-minis now versus the TQQ or the QQQ?
Because I go short during the day.
You get more leverage? I mean,
No, nothing to do with leverage. Well, it's a highly leveraged vehicle. The Qs to be the TQQ. Excuse me. The futures are highly leveraged to begin with. But I'm saying if I'm looking at my chart and I see we're coming up to a peak with the Keltner channels, it's breaking the 2 and 3 Keltner channel and curving down, I go short. I press a button and I sell.
But what's the benefit of the futures for you versus the ETFs?
It's a much faster moving vehicle and much more profitable. And you get much more leverage.
So it is more leverage, more profitable.
Highly leveraged.
Okay. Just making sure everyone realizes that.
If it moves, let's say 40 points in 2 minutes, that's $800.
And you got to have more.
That's one contract.
You got to have more capital, more collateral to run the E-minis than an ETF.
Yeah, in general.
Right.
It's a dangerous vehicle if you're trying to, do something that's ridiculous, or you have some trading plans that haven't been tested out, because you can get killed in it. But this market has been tremendous. In other words,
with the futures.
You can test any strategy, back test any strategy.
But you wouldn't test it live with the futures. You'd run it with the ETFs a little bit first before you roll it into the futures.
Absolutely. Absolutely. What's interesting about TQQ is that from January to the April 7th low, it was down about 60%. And then from April 7th to now, it's up about 150%.
And E-minis?
Well, they're all the same as far as percentages. But the amount of money you make is much different.
Okay. Let's move on to the next question I have for you. But thank you for diving deep into the weeds there. What are the stock market essentials? You do a chapter on that. What are the essentials?
Well, the essentials are, you have to be aware of all the axioms out there, that they say you can't use market timing, and the market's efficient, and you don't want to miss the
best days.
The best days. And, they just keep pounding the pavement and saying a lot of ridiculous things.
Just to keep you in, right?
Excuse me?
It's just to keep you in the market so you never sell.
To keep you in the market. And, all these big firms, they want to keep their assets under management. And they don't really tell you the truth sometimes. It's amazing. I still see ads from the big firms about missing the best days without telling you about missing the worst days, because if you miss the worst days, you do much better. So
agreed. Yeah, we've done some work on that. So what are some of those axioms, or what are some of the things
Let me check here for a second.
Yeah, while you're looking, what are some of the ones that are true? Don't fight the tape, don't fight the Fed.
What's true is market timing works. That's why I wrote a book about it.
I see it behind you.
And, based on your work and your dad's work as well, timing works. If timing didn't work, then there would be no excuse not to buy and hold. But if there's a way not to get hit by bear markets by simply using a moving average, like a 200-day moving average, which gets you out and reduces the risk, you're much better off doing that, especially in a retirement account. We have no tax consequences.
That's right.
So there are a lot of things out there that people do that they should be very careful about. I also spend a lot of time explaining bull and bear market cycles, which occur periodically over time, and people should expect them. And people should be aware of the fact that their retirement account is an interesting place to play in the market because, especially with a Roth account, anything they take out of a Roth IRA account won't be taxed. So if you want to put TQQ into a Roth account and let it run, you won't have to pay tax on the proceeds when you take them out. So that's an interesting place to play that.
I like that.
Yeah.
So you talk about the QQQ siblings in the book. What are they?
The QQQ alternatives are different QQQ offshoots. In other words, you have QQQM, as in Michael, which is the same exact portfolio as the triple Q, except that the expense ratio is 5 basis points less. Okay. And then you have other ETFs, QQQA, and all these other ones that are a little different than the QQQ, different offsets to it. And then you have a number of ETFs that use options strategies on the QQQ. So what's happened over the years is that a lot of firms, including Invesco, which pushes out QQQ, have come out with strategies based on the NASDAQ 100 index. And then they produce ETFs, and then they look for, to capture assets. The problem with all the QQQ alternatives, which there are about 15 now, they haven't done as well as the QQQ itself.
Just a straight up not leveraged QQQ.
Correct. They all have different capabilities.
That makes me feel comfortable that that's the one that I like to trade, or that I like, especially for our best month strategy. Just straight up regular Qs.
Well, you can trade actually if you want to. If you have a longer term strategy, use QQQM as in Michael, and you get the 5 basis point advantage.
But that's leveraged. Is that triple? Well,
no.
That's just the regular one times.
QQQM is the regular one with a.
All right.
It's 0.15 versus 0.20.
I'm going to look it up right now. I think
QQM is in Michael. It also comes out by Invesco.
So it's just less fees than the Qs.
It has less assets than the Qs do.
What's the difference in the assets?
I don't know the exact number, but the QQQ.
I don't mean the AUM. I mean, the same holdings?
Oh, exactly the same holdings.
Okay.
No, Invesco came out with it. They came out with their own competitor, which is very smart. They have I think a very fair, a big AUM there as well. First of all, the QQQ is now about 350 billion. The QQQ.
So how is it cheaper? Like, well, how do they make it cheaper?
They reduced the internal expense ratio.
So they're just eating it.
Excuse me?
They're just eating the expense.
The extra 0.05.
All right, so
they have a couple of hundred.
Favorite sibling.
They have a couple of 100 million in there.
We talked about a lot of technical indicators early on, and I appreciate that, and thank you for that. You have a full chapter on it. Was there anything we missed in our previous discussion of your technical indicators? You had Keltner Channels, the 20 simple, the 8, the 6, 13, 5.
Yeah, I have two other things I mentioned. One is the percentage of New York Stock Exchange stocks that are, or actually NASDAQ, what percentage of the NASDAQ stocks are on bullish point and figure chart signals?
Oh my God, old school.
Yeah, it's old school. And when that number dips to a very low level, like 10 or 20%, that usually means we're at a market bottom. Another thing is the percentage of stocks that are below the 20-day moving average. When that dips to a low level, that's another indicator. So those are things you can use in conjunction with the ones we just mentioned. And I have what's called a composite indicator, which blends 6 of them together. And when at least 3 of them are positive, you go long. When three of them are negative, you go short. But the arbiter in the sand is the 20-day moving average.
That's your
So,
thing.
if you're using the MACD and it turns down and you're still above the 20-day moving average, you stay long, because a lot
And
of
these are
times.
all detailed in the book.
Oh, absolutely. You
Great.
have a lot of charts in the book. The book actually is 8.5 by 11 as far as size, because it's actually, you can see the difference in size between a standard
Awesome.
book and my book, because you want to be able to see the charts better. And also it's larger text in there. So I show all the indicators.
Only my readers, huh?
Yeah, yep.
You have a moving average back tested strategy for the QQQ. How's that work?
Yeah, so I put in a moving average, and I started with the 200-day, and I've worked it back till about the year 2000, and that did twice as good as just buy and hold with half the risk. And the one I found best was the 225-day moving average. That had the better return by about 10 or 15 percentage points. So it's about 1,000% it went up compared
So
to.
how does it work?
You just buy the QQQ when it crosses above the 200-day moving average.
225-day or 200-day?
Yes, yeah, in that case, and sell it when it drops below the 225, and then you're in cash everything all the other time.
So that's a long term. That's not a.
That's a long term, and it doesn't have that many signals, and it's done twice as well as buy and hold. So if that's an available strategy with half the risk, why wouldn't you do it?
I know some advisors who use a 200-day moving average. If the market or whatever the instrument falls below that, they're out.
Yeah, well, I used it.
It's not new, but sometimes these old things still work very well. Good to remember.
Absolutely. It didn't work well on the S&P and the Dow. Interestingly, it didn't work.
It's better on the Qs or the Nasdaq.
It only worked better on the Qs.
Okay.
Because it's more volatile. And don't forget, the Qs compared to the S&P over the past 20, 30 years, the Qs have doubled it. They've doubled the S&P since the inception in 1999. So that's the place to be if you want more action and you want more tech exposure.
So what's your biggest concern for people trading the TQQQ?
The biggest concern is you want to be very careful in the strategy you use, and you want to protect against the downside as much as possible. So you better have very good defensive strategies, whether you use a stop limit order or some other defensive tactic. You want to be out of there before it takes you out of there.
Or the 20 period moving average, or one of your.
Well, I would say during the day I use the 8 EMA.
So the 8-minute EMA.
Yeah, in other words, even if you put an 8 EMA on a daily chart, it hugs beautifully that line. And as a secondary line, you can use the 20-day. So if it drops below the 8, but still above the 20, you can probably still hold it safely.
Okay, and that's over any period, daily, minute, 5-minute, whatever you want.
Yes. It's a very good moving average to use. Also, I should mention, every stock and ETF has their unique best moving averages. So, for example, on the QQQ, it may be 8. On the S&P, it could be 7 or 10. On the Dow, it could be 11 or 12, or a longer period. So if you're dealing with any type of trading vehicle, bring it back as far as the vehicle exists, as far as the data, and throw some moving averages on it and eyeball it and see which of the shorter ones captures most of the up or downswing without too many whipsaws. The worst thing you can have is a whipsaw every 2 minutes.
Right. Good advice. So how come you don't focus on the SQQQ at all, or much in the book?
The SQQ is if you want to be bearish.
And so you're not bearish.
No, you lose money. Imagine how much you would have lost this year.
So
Put up a
you're,
chart of
but you said
SQQ.
you go short during the day sometimes.
No, it's easy to short the NASDAQ futures. You press a button.
You prefer the short than the leveraged inverse,
Yeah, well, it's much easier, much cleaner, and much more profitable.
and less, there's less expense and less cost involved
Yeah,
in
it's on your screen. You go long or short. It's automatic almost. You know, sometimes I make more money in a down day because I'm making the rebounds during the day.
right.
If I showed you a 1 minute chart of any day and not tell you what the time frame is, you would have no idea that that could be a 1 day chart. You'd think it's a yearly chart.
Right.
The market moves very quickly. It moves in 50, 100-point segments all the time now. In other words, a 100-point move in the NASDAQ 100 or the E-mini happens all the time. That's $2,000. And that move can happen in 20 minutes or less. And then it reverses. So
So
I trade between 2 and 10 round trips a day.
you're a busy man.
No, I'm doing other things on my other screen. So I have indicators that work. I also put alerts on.
Do you trade all day, or do you have like a little window during the day that you trade?
No, I'm here because I'm doing other things. So I usually trade all day, but I'm not really trading all day. I'm doing other things, awaiting the movement of
You have
the
alerts that ding that tell you when things happen.
yeah, no, the alerts tell me when I reach a certain price. And then I look at the screen and see if it reached my price. What happens a lot of times is I'm putting a price way below the market with an alert, and I have an order in, and I miss it by a penny
Yeah.
or a quarter, and then it goes up 100 points. Or on the upside, I have a sell price up here, it gets to here, and then decays. So I miss, a better
So,
price because I was trying to get a certain price based on a pivot point, of
so
some level.
what's the lesson there for
I don't
traders?
know what the lesson is.
You
I
can't
wish
win
I
them
knew what
all.
the lesson is. You do the best you can.
Nobody bats 1,000, right?
No one ever bats 1,000. Actually, based on my experience and that of many traders, most traders lose on half their trades, even
I
the
always
best
thought
ones.
I always thought 60% was the sort of threshold for doing well. You want
No, it's
50
not.
50.
No, a lot of the best ones do 50. You know
So
why?
you just cut
Because
your losses short.
yeah, they cut their losses short. Also, their risk to reward is at least 2 to 1, if not 4 to 1. That's how they do it. On the trades they lose a small amount, and the trades they win double, triple what they expect because that's what they're doing. They want to make at least twice as much on a trade as they
That's
would
the old
possibly lose.
that's the old axiom. Let your winners ride and sell your losers short, right?
To some extent, yes, but it's like I don't know if you know Mark Minervini.
No.
Okay, he's one of the top traders in the country. He is very careful about how he trades. He follows his rules, and he never breaks his rules. And
That's
he has an eighth grade education. He had a rough childhood, and he worked his way up. He learned about the markets. He became an expert. He has his own company, his own service, and he entered 2 U.S. trading championships. The last one about 2 years ago. He put $1 million in. It was all tracked by an outside outfit, and he made 330%. And he won that.
amazing.
He won that year, and he won 10 years ago also.
So
He has a
stick to
lot
the
of.
system. Never break your rules.
He never breaks his rules, and he has
Never change
an
them.
annual seminar that he runs every November, where he has uh, hundreds of people attending online to learn his methodology.
Does he ever change his rules?
He doesn't have to. He found his rules. He uses the Can Slim approach from William O'Neill, plus
Yep.
his other things that he developed, and he's like a machine.
So he doesn't need to change his rules for that, too.
He doesn't even take vacations. but he's up there in the very wealthy category, and he's very highly thought of because he knows what he's doing. He follows his rules, and a lot of people he made multi-millionaires.
All right. So the last chapter focuses on buy and holding the TQQ. You've been talking about that a little bit. Why, you're a trader, you're a day trader, you're a big fan of market timing. Why the change? Why the change of heart? Why buy and hold now?
Well, I didn't change of heart. It just felt that the TQQ has had so much tremendous performance over the years that if you take a small amount of money and put it in there and let it ride for a long time, you can do very, very well. That's the only reason. I mean, I think since its inception in 2010, there are 4 years or 5 years where it's gone up more than 100%.
Right.
And the down year, it had a very bad year in 2022. And if you looked at the chart, you'd say the chart is terrible looking. Yeah, it is for that year. But overall, when something goes up 24,000%, you want to take notice.
Take note. Yep.
So when I was thinking about that chapter, I said, you know what? For grandkids and for your own children, and if you have some extra money and you won't lose it, if you lose 1 or 2% of your money, it's not a big deal. Put it away for them. Imagine you have a new grandchild, you put $5,000 in TQQQ after it drops 25%. Imagine what that can be in 20 years.
I'm gonna tell my sons. My youngest is going to be 18. He's ready to open up an account. I'm going to tell him go for the TQQ and hang on.
Only if he can afford it now, not to use real money that he needs.
Well, maybe we'll gift it to him for his 18th.
You gift him a little money.
Yeah, a couple of bucks. So, last question: is there an 8th book in your future? Is there an 8th book wonder coming from Les Masonson?
I don't know. I'm still interested in sector rotation. I'm trying to conquer that. I haven't been able to yet. So if there is an 8th book, I would do it on that subject. But writing a book, as you know, is
a tyrant.
Is very difficult. And this one was very difficult because I had to get approvals from 20, 30 different people to use in exhibits and charts. And the big banks wouldn't let me do anything without paying them a fee, even for one chart. And then I have to, proofread everything and test everything. And it's just too much work. But I may do one, we'll see, but not for a while.
Well, I'd love to talk to you more about the sector rotation because that's something we do too. And I appreciate you and your work and your efforts, your trading knowledge. Appreciate the education today. So thanks for joining me, Les. Thanks everyone for tuning in. And again, I'm Jeffrey Hirsch for WealthWise on Biz Talk Today TV, available wherever you stream your podcasts. For more information on the Stock Traders Almanac and the new 2026 Almanac and my newsletter, go to stocktradersalmanac.com. Check me out on social at Almanac Trader or just Google me, the Almanac, and I will see everybody next time. Thanks again.